Good evening, Happy New Year edition. This is Ken Long from Tortoise Capital with a review of the weekend trading plan for December 28th, 2013. We have a market that is in bullish normal conditions. On an annual basis, using weekly RSI 14, we're overbought at 74 out of 100. On a short-term basis, using the 10-day NDX, we are also overbought at 98 out of 100. Looking at the market mosaic, price relative to the 200-day moving average is white bullish at 10.17, so we have about 8% buffer towards sideways channel. The 5-day slope of the 50-day moving average improved to green bullish at 0.71%. ADX 14 improved slightly for the bulls to 18.5, but we're still neutral with respect to trend. ATR percentage, the measure of market volatility, is still normal at 0.93%. The risk index is the 30-period moving average of the VIX divided by the 10. That computes to 0.98, so we are still marginally risk off. You take that score of 0.98 and compare it to the last 5,000 trading days. It gives us a standard deviation score of minus 0.3. Z-squared minus 0.3. Here you can see the 90-day time series on that indicator, and the decline of volatility here for the risk index is favorable for the long side. No signals in the channeling or overreaction. You can see that volatility spike has pulled back to the 6-month normal, and that the bulls are in charge here on ADX, but it's still very low. 10-day max pain candidates of interest: Procter & Gamble, Boeing, Pfizer, Walmart, Microsoft in the Dow. The volatility ETFs, emerging markets, Russia, and gold in the ETF 100. We have VXX on a triple screen, and then the auto framer showing 4 symbols test out well on the mechanical swing based on their trade location. A handful of dojis in the Dow, no patterns other than the usual 5 max pain range compressions. You can see how strong 3M has been here over the last look back periods of 1 day, 10 day, 1 month, 3 months, 6 and 12 months. It's been very strong, and you can see on the index that it achieved a multi-time frame breakout on Fridays, and the same is true of ExxonMobil and United Technologies. Cisco on a 10-day and 1 month breakout. Coke on a 1-day breakout. 10-day breakout. Chevron on a 10-day and 1 month breakout, and Merck on a 10-day breakout. Microsoft, Boeing, Intel, Disney were the big percent losers. On Friday, the big winners: Coca-Cola, Cisco, ExxonMobil, and 3M. Inside the ETF tactical, no signals on the RSI2, only 3 dojis. We have 1 triple screen in the VIX, 4 test out well on the auto framer. That's the VIX, gold, treasuries, and emerging markets. XIV, the inverse VIX, has had a brilliant run this last month and finally gave back a little bit on Friday, but still managed to close at a significant high for the week. So that will be one to watch. Looking at the auto framer, the 4 that test out on the reward to risk, you can see the framing data posted here. The market mosaic charts, I improved the right up here, so hopefully it'll be a little easier to see what we're talking about. You can see this low volume week was really good for the markets. 30-day regression line slope is up. The polynomial regression line is rocketing skyward. This was strong enough for the 30-period regression line to cross its own 10-period moving average below the 6-month average, and so it's starting to hook up. That could bode well for the next leg up. You can see the 6-month time series of that slope and its 10-day. The percent stretch compared to the 200-day moving average is nothing exceptional here at about 11%. We're still right at the 6-month moving average, and we're not extended by any means. And volatility is normal by both measures of volatility. A number of charts just for reference: the fail stat, the signal to noise ratio, S&P volatility, swing z-scores. You'll notice that all of the U.S. Symbols are above average on their z-scores, and many of the globals are lagging on the 20-day and 40-day. So this has been a market that has been favoring the U.S. The z-scores of the regression line slopes, you can see that the 90-period slope is still very positive. The 30 came down to the median, right here to the 0 line in the middle of the channel, and is finding support. So that says that there's room for a leg up on the intermediate term time frame after these last 30 days of basically sideways performance. And the 10-day has given a little bit of surge to join the 90. So this is really actually the equivalent of a buy on dip when you have the short term and the long term trends very strong, and then the intermediate term has had a pullback and starting to hook up. That's almost like a triple screen. You can see what that looks like in terms of this breakout as we were prepared for. It came down and tested the bottom of the river, and now price has broken out to new highs, and that's very favorable. Let's see if it can hold this here during the low volume holidays. Fraud candidates holding days report, gap statistics, and intraday performances on a variety of usual suspects. The Dow 30 report, the quality report, that is, the ETF quality report, the transportation sector quality report, and correlations of the main indices. This is a new one. I've been tracking this personally for a while, but I thought I'd go ahead and add it back into the daily. This is a measure of the degree of correlation between broad global indices and the S&P. So we've subtracted out the S&P's value here and converted all of these correlation coefficients using the z-score. So this tells you the relative degree of correlation compared to each index's historical performance. And so you can see the ones that are above the 0 line are ones that are more strongly correlated, and the ones the fact that almost all of them are under the 0 line says that there has been actually quite a bit of uncorrelation here in this bullish market we've had over the last 6 months. The least correlated being looks like the NASDAQ, and the most correlated being up here in the with Japan in terms of their historical correlations. And then this one measures, the second chart measures the width or the height of that channel going from the least correlated to the most correlated. And what happens in bull markets is these correlations start getting wider, and so you would find them uncorrelated. And then in bear markets that have a global effect, you'll see those correlations go to 0, and then that would drive all of these z-scores way up. The fact that all these are now below 0 is an indication just that we're in the middle of bullish conditions. And then the width of that channel, between the most correlated to the least correlated on z-scores, is reflected in this time series chart, and it just tells you how tightly things are correlated. And at the end of the selling period, you'll see that actually start coming down a little bit here as correlations tighten up. So this is sort of an indirect measure of assessing what the state of the broad global markets are in bullish expansions and bearish convergences. Um, these two regions down here were the periods of the last sell-off periods, and then as the market recovers and things start doing well, then correlations get wider, the width of the channel gets wider, and then this becomes a function of a measure of divergence as capital starts seeking winning positions in the world. So it's sort of an indirect measure of market psychology. We want to shift over to the daily report. I've added a new summary chart for you, just so that that'll come out with each of the dailies, so you can sort of see what each of those 20 charts in the daily report look like. And so the cover page is this one, shows a table of contents. What we just reviewed was the actual daily report itself. Looking at the summary, the Dow 30, the ETF 30, and the auto framer. Those 4 pages for me really are the primaries. Primary resource for developing daily trading plans. Pages 6 through 20, additional layers of research, are the ones we've just sort of quickly reviewed. And this should help you just sort of quickly find things that you're looking for. I want to get back now to the, because that had the biggest change, I want to get back to the weekly strategy reports. I went a little bit out of order this week. So no change to what we've already just seen. The blended monthly rebalancing portfolios will get adjusted next week. These are all still looking pretty strong. Next reevaluation on about 1 January. The theoretical model in ETF2 is at 70%. The model portfolio itself is at 100. If we had to go today with the blended monthly, we would have the NASDAQ small caps and large caps in the ETF 13. In ETF BMR 32, it would still be the NASDAQ industrials and consumer discretionary, followed by the small caps. In the ETF Max, it's the solar energy ETF. TAN has moved back up into second position, although it is still the only one in this top 50 that's on a cash position, with price at 34.83 compared to its 4-month moving average of 35.18. But otherwise, the leaders have continued to lead, and that's going to be Greece, Egypt, India, Nasdaq, the internet portfolio, and otherwise the top 50 remain pretty much intact from last week. Looking at the market health check now. Our vertical blue lines are 10, 20, and 30 days worth of look back. 10, 20, and 30 days of look back. The horizontal red lines are support levels that used to be resistance. You can see this red shaded area is the 200 period moving average, and the area under the curve is the, where it starts getting painful. The green, yellow, and red are my intuitive price regions where I want to be long. The strongest sectors or symbols in the green, short the weakest sectors in the red, and otherwise I'm going with the strongest trend of the particular day that's in line with the market condition when we're in yellow, between like 184 and 178. That's sort of the tactical noise that offers opportunities to intraday traders. But I don't see a change in trend until either price goes into the green or into the red. It doesn't take much more to get it into the green, basically just making a brand new high. And so that's where my bias is. It's very easy for me to get long and stay long. it has a ways to go before I could be convinced to start looking at shorts for extended periods. Otherwise, it's just tactical trading in this region. The red dotted line is just showing that I don't really consider this to be a support level yet because of the low volume of this last holiday week. But if we get some continued strength, then that will be the next support level. The dark blue shaded area is the um, river. That's the 30 period Bollinger Band plus or minus 1. The shaded blue area, Bollinger Band plus or minus 2. That's the floodplain. The dark red ribbon in the middle is the dragon. That's the 10 period Bollinger Band plus or minus 0.5. That quite often acts as a indicator for the trend that will emerge in the river. You can see back here in end of September and October, um, the river was sideways, but what we had was a low and then a higher low and then broke out to a new high here in the dragon, and that sort of was the leading edge of what then became about a 40 or 50 day move up. So that dragon actually acts as an early warning change in current for that river. This thin black line is the time series of the 30 period regression line slope. And what that does is maps the day-to-day value of this thin black line here that's in this 30-day channel. You can see that that's up right now, and it's now starting to get stronger. As long as it's above this zero line here, then that means the slope of that 30 is higher. And so it's gotten as high as 0.375 slope and as low as minus 0.225. Those are sort of extreme readings. And then here is the zero line in this middle range. As long as this slope value is above this zero line, then the slope of the 30 is up, and that's good long term for the market. In this past week, what we had was the market that slope starting to get weaker and weaker, and it went from this period of growth in October and November to about 30 days of sideways movement. But these last 5 days have caused that slope to stop decaying back towards zero, where I projected it would probably have reached here. But by Friday, it actually had turned steeper and now is getting measurably better as we start to see price leaving this support level, or this pricing base here between like 178 and 181. Now we'll see once the holidays get over if that's going to continue to hold. But there was a lot of willingness to just hold positions here, even if there wasn't a lot of new buying. But this is really the first sign of buying ahead of what could be January money coming into the market. So these blue circles now on this slope function show where it reached extreme down, extreme ups, and then places where it crossed the zero line. The last time that that slope decayed and was almost going to come back to the zero line but reversed to go higher was here in the middle of October, and you can see that we've then went from about 171 to 184 in that period of time. So with most of that growth occurring in here, it got as steep as 0.375 here and then started to decay, and now instead of failing below zero and going negative, it actually has hooked up, and I consider that to be a positive sign, because long term what we have is in terms of the slope, was a low, a higher low, and another higher low here. So these are all favorable in my view for the long-term indicator, and what that suggests is that we've still got quite a ways to go before we will get to any kind of an extreme performance over 30 days. So this is, I think, good news for the long-term trend. The Williams percent R shows us overbought. It can stay overbought for a long time, so that's not surprising. These were all good channeling entries way back here the last time it was overbought, or oversold. And the bottom indicator here is the percent price oscillator. It completed a negative journey here in the last 20 days. Granted, the market was only sideways, but it came down to a nice low base, started to hook up here, which gave us a alert of a potential state change when we had that powerful move in the previous week, and the jaws of PPO are now open to the upside, and we're starting to get some range expansion, so that's good for the intermediate term as well. This is still at a low level that we haven't run out of intermediate term strength. So there are some good reasons to believe in the longer term performance potential right now. ETF2, the main regions, 7 out of 10 are on a buy signal, so that puts us at, and keeps us at 70-30 in the theoretical model. The S&P is better than the globals, with 88 better than 84. Inside the U.S., it's technology, small caps, large caps, mid caps, and then technology and the Russell are the two strongest world regions. The two weakest remain Latin America at 74 and Asia less Japan at 77. Inside the S&P sector, Spider, it's still materials and industrials, along with technology, healthcare, discretionary. Only utilities are lagging, but even that at 78 is still pretty strong. Uh, World market model, everything U.S. is above average. The technology, large and small caps, exceptionally strong. China exceptionally strong. Germany and Spain exceptionally strong. Just about everything else, though, in Asia, Asia list Japan is weak, with the exception of South Korea, Thailand, Philippines, and Indonesia, along with the broad trend in emerging markets, especially hurting. Latin American emerging markets below average, Canada above average, Mexico and Brazil are weak and exceptionally weak, respectively. Everything Europe is strong, especially Germany and Spain. Japan and Asia less Japan have fallen back underneath the database average there. Just watching my second string Chiefs end the season for the San Diego Chargers. Go Chiefs. ETF top 30, little difference between this and what you saw in the blended monthly rebalancing, so I'm not going to cover that. The Dow 30, a ton of large caps looking really strong now, with new money coming into, it looks like Disney, ExxonMobil, Visa, DuPont, Goldman Sachs, that whole financial sector being represented in there. So you might want to be looking at XLF and FAS as the triple leveraged financials. Only Cisco now in the red from the Dow, and quite a lot of above average. So this is really testimony to the strength of the U.S. large caps here. And that'll do it for the weekend report, and then just sort of the reorganized Tortoise Daily report. Hopefully that'll help you find what you're looking for a little easier as we go forward. So it's Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.